The United States government owes $37 trillion, a number so large it no longer feels real. More debt than any empire, kingdom, or republic has ever carried. More debt than the entire global economy produced in a year just 2 decades ago. And yet, in the quiet hum of daily headlines, there is no panic. No emergency speeches. No nationwide austerity campaigns. Why? Because Washington isn't preparing to pay this debt. They're preparing to erase it. Not through default. Not through taxes. Not through spending cuts no politician has the courage to touch. But through something far older, far quieter, and far more devastating. Currency devaluation. The slow, invisible siphoning of purchasing power from every person holding dollars. A theft executed in daylight. A reset disguised as strategy. And the mechanism? Not the Federal Reserve printing press, not the Treasury bond market, but something most Americans believe stands outside state control. Crypto and gold. You're watching the US government build a parallel financial system. Accumulating strategic reserves, shaping new narratives, and preparing to revalue Bitcoin and gold at levels the world has never seen. The goal? To magically strengthen their balance sheet, while quietly vaporizing the real value of your savings. This is not fiction. It is a playbook with historical fingerprints stretching back centuries. A method used by collapsing empires, war-torn nations, and financially cornered governments. From Rome's silver debasement to France's Assignat collapse to America's own 1933 gold revaluation under FDR. And the part that should chill you, every time this strategy has been used, one group survives and another group is sacrificed. In the coming minutes, you will understand exactly how this modern reset works. How governments mathematically delete impossible debts by redefining what money itself is worth. You will see the precedent, the mechanism, the timeline, and the outcome. A sequence already in motion. But before we move forward, we need to explode one of the most dangerous myths in economics. Government debt is not like your debt. When you owe money, you work longer hours, you cut spending, you sell assets, you sacrifice. When governments owe money, they do none of that. Because governments control the very thing debt is denominated in, the currency, which means they can simply rewrite the rules. They can redefine a dollar's value. They can revalue their own assets. They can legislate away the real weight of debt without ever repaying it. Economists call this a monetary reset. But in reality, it's a political decision with economic consequences. And it has happened repeatedly throughout American history. To understand the coming reset, we must return to the template. The moment the United States realized the power of revaluation. 1933. The first American reset. Picture the nation in 1933. America was staggering under the twin wreckage of the Great Depression and lingering World War I debt. Factories silent, banks failing, unemployment nearing 25%, deflation strangling the economy. Government debt sat at 40% of GDP, large for that time, unsustainable in that era. President Franklin D. Roosevelt knew the government could not repay its obligations at the existing price of gold. The numbers didn't work. The books could not balance. So he executed one of the boldest financial maneuvers in U.S. history. Revalue gold, devalue the dollar, erase the debt. At the time, gold had been fixed at $20.67 per ounce for more than half a century, a symbol of stability and an anchor for the currency. Roosevelt shattered that anchor. Through Executive Order 6102, FDR made private ownership of gold illegal. Citizens were forced, under threat of fines and imprisonment, to turn their gold into the government. In exchange, they received paper dollars at the official price, $20.67 per ounce. And then, once the gold was back in the government vaults, the price was revalued to $35 per ounce, an overnight 69% increase. Nothing changed in the physical world. No new gold was mined, no new factories were built, no debt was paid. But on paper, the US Treasury's gold reserves jumped from $4 billion to nearly $7 billion. A $2.8 billion game created out of thin air. The debt, measured in gold terms, shrank dramatically. The real burden fell from 40% of GDP to 25% within years. And who paid the price? Every American holding dollars. Their savings quietly lost purchasing power amid the inflation that followed. People who handed over gold at $20 watched it soar to $35, but were barred from buying it back. They were trapped in devalued dollars, while the government repaired its balance sheet with the wealth it had confiscated. It was elegant, it was brutal, and it worked. This was the first great modern reset, but it would not be the last. Today, the second reset begins. Fast forward 92 years. The numbers are no longer billions, they are trillions. America owes $37 trillion. A debt to GDP sits at 132%, higher than any. Interest payments alone have reached $1.2 trillion, more than, if interest rates remain near current levels, that figure will explode to $1.66. The government cannot tax its way out. It can, mathematic, but it can be dev. Just as in 1933, just as owned not just gold, but Bitcoin, are together forming a mechanism capable of vaporizing trillions of real debt burden and it is. On January, a strategy publicly, the announcement sounded patriotic, about digging friends, but bet they need an asset they can revalue. Just like gold in 1933, just like every collapsing empire in history. The US already holds more than 210,000 bit, more than 20. But the new directive? It doesn't stop at holding them. It instructs the Treasury to acquire, quietly, not by buying on open exchanges, but through seizures, fines against, mini partners. Accumulating Bitcoin cheaply, before revaluing, just as Roosevelt accumulated confiscated gold before revaluing that. History doesn't repeat, but it not, and. To understand the reset unfolding today, you must first understand how governments weaponize the price of assets. Not through markets, not through competition, but through definition. A currency issuer can simply declare a new price, and every ledger, every balance sheet, every contract denominated in that currency shifts instantly. That is the trick, the sleight of hand, the economic magic show used from ancient Mesopotamia to modern Washington. Because when a government can define the value of assets it owns, it can redefine the value of liabilities it owes. This is why the US government isn't just acquiring Bitcoin casually. It's building the foundation for something far larger, a dual revaluation mechanism. Bitcoin for the digital era, gold for the historical anchor. To see how this works, let's break the strategy down piece by piece. Bitcoin, the new weapon. Most Americans think Bitcoin is the ultimate outsider, the anti-government currency, the digital rebellion. But the most powerful governments in history don't fight revolutions they can absorb. They co-opt them. Right now, the US government holds just over 210,000 BTC, but that number is only the beginning. Senator Cynthia Lummis's bill proposes the US acquire 1 million Bitcoin over 5 years. At today's prices, that sounds ludicrous, too costly, too disruptive. But the government has an advantage no corporation or hedge fund possesses. They can acquire Bitcoin without buying it. They can seize it. They can settle lawsuits with it. They can mine it with subsidized or stranded energy. They can gather it through agencies that never disclose positions. And most importantly, they can do it quietly. The goal is not to accumulate Bitcoin at market price. It's to accumulate it before they redefine its price entirely. This is where the magic happens. Imagine this. By 2028, the US has accumulated 1 million Bitcoin at a blended cost of around $120,000 per coin. Then, seemingly out of nowhere, they announce, for strategic reserve purposes, Bitcoin is now valued at $1 million per BTC. This is not a prediction. This is the same tool Roosevelt used in 1934, revaluing an asset the government held in bulk to erase debt it could not repay. And just like gold in 1934, the private market follows the new official price over time. Not instantly, but inevitably. Why? Because when the largest financial entity on Earth says an asset is worth X, global markets eventually converge to X. Suddenly, the government's $120 billion Bitcoin stash becomes $1 trillion on paper. $1 trillion, created not through innovation, production, or productivity, but through accounting force. But Bitcoin is only half of the mechanism. To complete the reset, the government needs something older, something universal, something civilizational. It needs gold. Gold, the old weapon, sharpened again. The United States officially holds 8,133 tons of gold, about 261 million ounces, the largest stash in the world. At today's market price of roughly $2,800 per ounce, that gold is worth around $731 billion. But here's where the quiet brilliance of the strategy emerges. On the government's books, that gold is valued at $42.22 per ounce, not $2,800, not market price, not even close, $42. A price set half a century ago. Why would the government keep the official value absurdly low? For the same reason a poker player hides their best card until the final hand. It gives them maximum room for revaluation. And when a government revalues an asset from $42 to $20,000 per ounce, the transformation is violent. Suddenly, the US gold reserve goes from being worth $11 billion on paper to $5.2 trillion. $5 trillion, created in a single legislative move. No new mines, no new discoveries, no new productivity, just a new definition. Now combine that with Bitcoin's $1 trillion revaluation, and the US magically produces $6.2 trillion of new balance sheet strength. Not to pay debt, but to offset it. Debt to GDP improves. Balance sheets appear stronger. Markets breathe easier. Politicians declare victory. And the American middle class? They pay the price in silence. Because if gold jumps from $2,800 to $20,000 and Bitcoin from $100,000 to $1 million, the dollar must fall. You can't revalue gold upward without devaluing the dollar downward. They are opposite sides of a seesaw. And when the dollar falls, everything priced in dollars rises. Food, energy, rent, cars, insurance, utilities. The quiet robbery begins. The real target, your purchasing power. A reset is not a mechanical event. It's emotional, psychological, civilizational. When a government devalues its currency, it transfers wealth from savers to the state, from citizens to politicians, from workers to balance sheets. It is the only way an over-indebted nation preserves itself. The losers are always the same: savers, bondholders, pension funds, salaried workers, retirees, anyone whose wealth sits in cash or dollar-denominated assets. This is why governments opt for revaluation instead of austerity. Austerity angers voters. Revaluation confuses them. You don't riot against a policy you don't understand. You just feel your life getting more expensive, more fragile, more impossible. But the math is cold and indifferent. If gold is revalued to $20,000, the dollar loses roughly 85% of its purchasing power. If Bitcoin is revalued to $1 million, the dollar loses roughly 90% of its purchasing power relative to it. This doesn't require hyperinflation like Weimar Germany. It only requires persistent compounding inflation. 20% here, 30% there, over 3 to 5 years. And by the end of that window, your $100,000 in savings buys the equivalent of $30,000 to $35,000 today. Meanwhile, the government's $37 trillion debt shrinks in real terms to around $13 trillion. A full-scale wealth transfer, masked as stabilization. But this time, unlike 1933, the mechanism is not just domestic. The 2027 reset is engineered to ripple across the world. Because the US is not the only nation drowning in debt. Europe, Japan, China, India, almost every modern economy is facing the same trap. Too much debt, too little time. And beneath the surface, they're all preparing. The global chessboard. While Washington gathers Bitcoin and prepares gold for revaluation, the BRICS nations, Brazil, Russia, India, China, South Africa, have been amassing gold at the fastest rate in modern history. China's real gold reserves are estimated at 4,000 to 6,000 tons. Russia has over 2,300 tons. India is buying aggressively. Turkey too. Saudi Arabia quietly accumulating. Everyone is preparing for the same event, a global repricing of hard assets and a global devaluation of fiat currencies. Not coordinated through a treaty, but aligned through necessity. Because every government has the same problem, unpayable debt, and every government has the same escape hatch, devaluation. The US just intends to lead the process, or more accurately, control it. And now we enter the phase where theory becomes timeline, where policy becomes countdown. In the next part, we'll break down the 2025-2027 sequence, the exact path from accumulation to crisis, to revaluation, to collapse, to stabilization. This is where everything accelerates. Every monetary reset in history follows the same choreography. A period of quiet accumulation, followed by visible crisis, then a politically justified shock, and finally a new equilibrium that looks nothing like the world that came before. We are now entering that choreography again, but this time the dancers are larger, the stakes are higher, and the moves are digitally weaponized. To see the pattern clearly, we must walk through the coming timeline step by step. By the end of this part, you'll understand exactly how the next 2 years will unfold, and why the year 2027 is the fulcrum of the entire strategy. 2025. The accumulation phase. Right now, the clock is in its quietest stage. Congressional bills receive polite coverage. Executive orders are framed as technological progress. Government agencies build task forces and innovation councils. But beneath the surface, the accumulation is underway. 1. Covert Bitcoin acquisition. The US does not want the public or the market to know how much Bitcoin it is absorbing. That's why the acquisitions happen through DOJ and FBI crypto seizures, IRS enforcement actions, SEC settlements with exchanges, penalties paid in digital assets, energy-backed mining operations on federal land, private custodians working under non-disclosure agreements. Each of these channels feeds into the strategic Bitcoin reserve quietly. This is not a shopping spree. It's an intake valve, a silent vacuum pulling Bitcoin into federal control. 2. Narrative conditioning. No reset works unless the public is guided gently toward its emotional justification. That's why 2025 is filled with political messaging around digital currency leadership, monetary innovation, protecting American competitiveness, keeping up with China, securing the digital frontier. These phrases do not spark fear. They spark pride. And pride is the perfect veil for extraction. Just as FDR framed gold confiscation as patriotic, modern leaders will frame Bitcoin accumulation as visionary. 3. Gold becomes respectable again. Simultaneously, politicians begin muttering about sound money principles, partial gold backing, financial responsibility, restoring trust in the dollar. This prepares the ground for what's coming. Gold cannot be revalued overnight unless the public has been warmed up to the idea that gold is responsible policy. In the Great Depression, gold confiscation was justified as an act of stabilization. In 2027, gold revaluation will be framed the same way. The trap is being built one phrase at a time. 2026, the crisis phase. Every reset requires a crisis, not just to justify drastic action, but to make the public beg for it. And the US does not need to manufacture a crisis. It already exists. The only missing ingredient is timing. 1. The debt ceiling battle turns nuclear. By mid-2026, the debt ceiling fight becomes unmanageable. Both parties dig trenches. Markets wobble. Treasury warnings grow louder. Ratings agencies question US bonds. Then the unthinkable happens. Bond yields spike. This is the moment policymakers have dreaded for decades, when investors finally demand higher returns to compensate for rising risk. Higher yields mean higher interest costs. Higher interest costs mean higher deficits. Higher deficits mean higher bond issuance. A doom loop begins. 2. Liquidity drains from the system. Banks, already strained, tighten lending. Corporations struggle to refinance. Consumers default in rising numbers. The economy slows sharply. News cycles fill with phrases like historic volatility, market turbulence, unexpected tightening, growing recession risk, confidence crisis. These phrases normalize fear. Fear normalizes intervention. 3. The crisis creates the justification. In 1933, the financial collapse justified Roosevelt's gold seizure. In 1971, global imbalances justified Nixon closing the gold window. In 2008, bank failures justified trillion-dollar bailouts. In 2026, the justification will be, we must strengthen the nation's balance sheet to prevent collapse. And the public, terrified of losing their jobs, pensions and savings, will agree. They won't question the mechanism. They'll just want the pain to stop. This is the moment the government has been waiting for. A crisis so severe, the public accepts radical change. 2027, the revaluation phase. This is the heart of the reset. The year the world you know begins dissolving into a new one. 1. The announcement. In a televised address, the president, regardless of party, declares, "To restore strength and stability to the American financial system, we are launching the Strategic Hard Asset Initiative." This initiative includes two shocking policies. Policy A. Bitcoin revaluation. The US announces it holds 1 million BTC. It declares Bitcoin a strategic reserve asset. It sets the official reserve valuation at $1 million per coin. This does not instantly change the private trading price, but it defines a new floor backed by the world's most powerful government. Markets surge toward it. Speculators chase it. Foreign governments scramble to follow. Policy B. Gold revaluation. Simultaneously, the US declares, the dollar will now be partially backed by gold. Gold's official reserve price is now $20,000 per ounce, not the current $2,800. Again, markets don't hit $20,000 overnight, but they surge upward in the following months and years. The global financial system reprices instantly. Trillions in wealth migrate. Trillions in debt evaporate in real terms. 2. The dollar collapses in silence. No currency collapses visibly. It collapses in purchasing power. In the months following revaluation, grocery prices double. Rents surge. Energy costs explode. Insurance skyrockets. Savings shrink in real terms. Wages fail to keep up. The average American thinks prices are rising, but the truth is simpler. The dollar is dying. By 2028, the dollar has lost 60 to 70% of its purchasing power. By 2029, the real value of US debt has collapsed from $37 trillion to around $12 trillion. The mission is complete. 3. Markets whiplash toward a new reality. Asset prices inflate rapidly. Real estate doubles in nominal terms. Stocks hit all-time highs despite recession. Commodity prices go vertical. Bitcoin stabilizes between $500,000 to $800,000. Gold stabilizes between $15,000 to $18,000. People feel wealthier on paper, but poorer in reality. This is how every reset works. Nominal values go up. Real living standards go down. The wealthy who hold assets survive. The middle class who hold cash and wages collapse. A society split in two. Just like Weimar Germany, just like Argentina, just like Venezuela, just like every empire in decline. The United States will be no exception. After the reset, 2028 to 2030. By the end of the decade, the new system stabilizes. Hard assets become the center of wealth. The dollar exists, but weaker. Global trade shifts toward multi-currency settlements. BRICS nations peg their currencies loosely to gold. The US attempts a stronger digital dollar backed by partial reserves. But the damage is done. The wealth transfer, the largest since the Industrial Revolution, is complete. And most Americans never understood what happened. Because the mechanism wasn't violence. It wasn't a banking collapse. It wasn't a stock market crash. It was revaluation, the quiet weapon of governments cornered by their own debt. In the next part, we will reveal the winners and losers of the reset and how everyday people get caught in the crossfire without ever seeing the blade. Every monetary reset produces winners and losers. Not by accident, not by miscalculation, but by design. When governments destroy the value of currency to reduce their own debts, someone must absorb the loss. Someone must carry the weight. And throughout history, that someone is almost always the same group. People who did everything right according to the system that is now betraying them. Let's break down exactly who rises and who is sacrificed in the US revaluation coming in 2027. The winners. 1. The US government, the primary beneficiary. The biggest winner is the US government itself. They owe $37 trillion. But after the revaluation shock, the inflationary wave, and the USD's collapse in real terms, the burden falls to around $12 to $13 trillion. In effect, the government erases $24 trillion of obligations. Not through taxation, not through repayment, but through mathematical manipulation of the currency they created. The debt crisis magically becomes manageable. Politicians claim victory. Fiscal hawks declare the reset a return to responsibility. Financial journalists praise Washington for bold monetary leadership. In reality, the state simply shifted the cost of its debt onto 330 million citizens who had no say. History is clear. The government never loses in a reset. Only its people do. 2. Politicians, the untouched class. The political class survives untouched. Their salaries are indexed. Their assets diversify automatically. Their insider networks warn them early. Their wealth sits in trusts, equities, and land, all of which surge when the dollar falls. They also escape accountability. Politicians don't have to cut Social Security. They don't have to raise taxes. They don't have to propose unpopular austerity. They simply let inflation do the dirty work. Every politician dreams of solving a crisis without sacrificing their career. Revaluation is the perfect weapon for that. 3. Early Bitcoin holders. For a decade, early Bitcoin adopters were mocked as tech nerds, libertarians, or paranoid outsiders. After the reset, they emerge as one of the wealthiest cohorts on the planet. Someone who bought Bitcoin at $30,000, $10,000, or even $1,000 and holds through the 2025 to 2027 volatility will see valuations climb into the hundreds of thousands, possibly touching $1 million as the US official valuation bleeds into the private market. When the world switches from fiat to hard asset logic, Bitcoin becomes a monetary super asset. But only for those who held through the storm. 4. Gold holders, the ancient winners. For 5,000 years, gold has outlived kings, empires, currencies, wars, collapses, entire civilizations. When fiat dies, gold rises. Always. Gold holders will watch their metal soar toward $10,000. Then $15,000, then stabilize around $18,000 to $20,000. Their purchasing power not only survives, it increases. In every reset, Rome, Byzantium, France, Weimar, gold returned the people who held it to economic safety. It will do so again. 5. The wealthy, those who own, not earn. The wealthy always survive resets because they own stocks, real estate, businesses, land, commodities, private equity, art, infrastructure assets. Every one of these rises nominally during a currency collapse, not because the assets become more valuable, but because the measuring stick, the currency, becomes weaker. Wealthy families emerge from resets not just intact, but stronger. The gap widens. The hierarchy hardens. The social ladder fractures. This is how the middle class dies. The losers. 1. The middle class. the sacrificial generation. No group is hit harder than the middle class. They keep their wealth in cash, savings, bank deposits, 401k bonds, dollar-denominated pensions, wages. Every one of these is annihilated by inflation. The typical middle-class American sees their life savings, $40,000, $80,000, maybe $120,000, collapse in real purchasing power. The home they worked 30 years to pay for becomes twice as expensive to maintain. Property taxes rise, insurance rises, utilities rise, groceries rise. But wages? Wages lag inflation by years. Real wages fall 40 to 60%. Within 3 years, the middle class is reclassified as working poor. This is not speculation. This is what happened. In Weimar, Germany. In Argentina, multiple times. In 1980s Mexico. In 1990s Russia. In 2000s Zimbabwe. In 2010s Venezuela. Currency collapses erase the middle class. Every time. 2. Retirees. Fixed income becomes no income. Retirees are hit brutally. They rely on Social Security, fixed pensions, annuities, treasury-heavy retirement portfolios. All of these pay out in dollars, the very thing being destroyed. Someone living on $3,000 a month today will find it equivalent to $1,000 or less in purchasing power. Medical care rises, rent rises, food rises, but income stays fixed. This is how a lifetime of responsible saving turns into unexpected poverty. 3. Bondholders, the silent casualties. Anyone holding government debt becomes an economic casualty. Treasuries will still pay the promised amount, but those dollars will buy 70 to 80% less. Bond funds collapse in real terms. Corporate bonds erode. Municipal pensions implode. In every reset, government debt holders take the hit. French bondholders in 1789. Russian bondholders in 1917. German bondholders in 1923. British bondholders post-World War II. The US will be no different. Bondholders are the silent, unsuspecting donors funding the government's escape from insolvency. 4. Renters, the forgotten group. When the dollar weakens, landlords raise rents. 20% rent hikes in a single year. In a reset, many are pushed out of cities entirely, not bite. 5. Workers cannot outrun inflation. 2. Inflation is immediate. 9. Employ workers. For live, real wages drop 40 to 50%. A society once defined by upward mobility becomes defined by desperation. This is not theory. This is historical repetition. Why this happens every time. In every nation with unpayable debt, the government faces two choices: default or devalue. Default destroys government credibility. Devaluation destroys citizen savings. Governments protect themselves first. Always. The pattern never deviates. And the US, despite its power, size, and prestige, is now bound by the same mathematical laws. The reset is not ideology, it is necessity. What comes next? Now that you understand the winners and losers, we must move into the next layer. What you must do to survive the reset. Not fear porn, not panic, not fantasy. A rational, historically grounded strategy based on what has worked for thousands of years in every currency collapse ever recorded. The rules are always the same. The playbook is always the same. The only variable is whether you act before the window closes. And that window is closing fast. In the next part, we will walk through the survival plan, step by step, and timeline aligned.